Hey guys, welcome back to the channel. Have you seen risk management videos where people talk about the necessity of maintaining a proper reward to risk ratio for all your trades so as to stay profitable over the long run? But is it the complete truth, or is it just half-boiled, half-cooked information that they are providing us? Even I am a culprit of this half-truth, because in most of my YouTube short videos, I talk about setting your reward at least 2 times the minimum risk for all your trades. Please note that the intention here is not wrong. The idea is to make traders conscious of the importance of having to manage their risk. But the hard fact is that the reward to risk ratio by itself can't be a standalone metric that can determine your risk and make you profitable over the long run. So in this video, I will help you dive deep into the risk management part of trading so as to give you a clear picture of how to manage your risk like a pro trader. But before that, let's set a target of at least 500 likes on this video so that I can come up with more such videos on risk management. And if you are new to the channel, please do subscribe and enable the bell icon so that you won't miss out on any upcoming videos. The reward to risk or return to risk ratio measures how much potential reward or return is available for the taking for every rupee that you risk in the market. For example, if you have a reward to risk of 3:1, it means you are risking 1 rupee to potentially make 3 rupees. Similarly, if you have a reward to risk of, let's say, 5:1, it means you are risking 1 rupee to potentially make 5 rupees. You get the idea, right? Now, a partial truth or information that you have been often told about reward to risk ratio is that you need to maintain a minimum of 2:1 reward to risk ratio. Now, this is not a very useful information because the reward to risk ratio is meaningless on its own and it should not be used as a standalone metric. Now, let me prove this with an example. Let's say you have a reward to risk ratio of 2:1. That is, for every trade you succeed, you make 2 times the amount you have risked. But let's assume that your winning rate is just 30%. So out of 10 trades, you have 7 losing trades and 3 winning trades. Now let's do some math. The total loss of a rupee over 7 losing trades will turn out to be 7 rupees loss, while a total profit gain of 2 rupees over the 3 winners will come down to be 6 rupees gained. Now adding both of them together, we are at a net loss of 1 rupee. Now let us take another example where your reward to risk is 0.5:1, meaning that you make 0.5 rupees on your winners and lose 1 rupee on your losers. Now let us assume that you have a winning accuracy of 80% in this case. So out of every 10 trades, you have 8 winners and 2 losers. Now do the math again. A total profit gain of 0.5 rupees over 8 winners gives you a 4 rupees profit, and a total loss of 1 rupee each on your 2 losing trades will turn out to be 2 rupees loss. Now adding both of them together, we have a net profit of 2 rupees. By now, I hope you understand that reward to risk ratio by itself is a pointless metric because a 2:1 reward to risk ratio does not guarantee a profitable trade, and a reward to risk of 0.5:1 is good enough to generate a profit over the long run, even though I don't generally recommend a reward to risk less than 1. So instead of following it blindly, you must combine your reward to risk with your winning rate in order to know whether you make money in the long run using a particular strategy or system. Now this is known as your expectancy, and if you're a trader, it is a super important concept for you to grasp before dumping too much money into the stock market. In fact, in any kind of trading, there are basically 2 forces at work: your probability and reward to risk. As you may all know, probability means how likely is that your trade will be correct. For example, a random trade like buying or selling has a 50% probability of success. Together, these 2 forces form the trader's equation, which is the trade expectancy formula. And expectancy is given by potential reward multiplied by the win probability minus potential loss multiplied by the loss probability. Or in short, the formula can be written as expectancy is equal to 1 plus W by L multiplied by P minus 1, where W means the size of your average win, L means the size of your average loss, and P means your winning rate. Out of the 2 formulas, I personally recommend you use the first one as it is easier to comprehend and make sense of. As I have mentioned, this formula can be used to analyze both individual trades you are considering taking and the performance of trading systems in general. Now, the trading system performance can be calculated using the equation expectancy is equal to average win multiplied by the win rate minus average loss multiplied by the loss rate, which is almost the same concept. Now, in either case, if expectancy number is positive, it is good, and if it is not positive, it is bad. Now let us take an example to understand this better. Let us say you have taken 10 trades, out of which 6 are winning trades and 4 are losing trades. This means your percentage win ratio or the win probability is 6 by 10 or 60% and your losing probability is 40%. Now if your 6 winners bought you a profit of 6,000 rupees, then your average win is 6,000 divided by 6, which is equal to 1,000 rupees per winning trade. Similarly, if your 4 losers total to 2,000 rupees, then your average loss is 2,000 divided by 4, which is 500 rupees per losing trade. Now apply these figures to the trade expectancy formula and the expectancy will come out to be 400 rupees using the first formula or 0.80 or 80% using the second formula. In this example, the expectancy of your trading system is 80% or 400 rupees, which is a positive expectancy. Now, what does this number actually mean? It is simply the average amount that you can expect to win or lose per trade with your system or strategy when a large number of trades are taken. Ideally, a sample size of 30 to 100 trades is perfect for expectancy calculation. Now, when a trader makes 6,000 rupees and loses 2,000 rupees, the net reward is 4,000 rupees. And when taken an average of 10 trades, you will get an amount equal to 400 rupees per trade, or in simple words, you will get 400 rupees per trade using this strategy. Let us look at a few more examples using this formula to understand this concept better. For instance, if you are someone who always look for reversal trades that have at least a 2:1 reward to risk ratio and assuming a 50% probability of success, then your trade expectancy formula will give you a positive expectancy of 0.5 or 50%, which is actually very good. A 50% positive expectancy means that your strategy or system will return 50 paise for every 1 rupee over the long run if you keep your risk equivalent to 1% of your account every trade. Now, what if we assume a higher win probability of 70% but keeping the reward to the same at 2:1? Then our expectancy will come to be 1.1 or 110%. Now, as stated earlier, a higher probability will certainly benefit. However, if you keep the probability the same as in the second example and just increase your reward to risk ratio to 3:1, then the result can be interesting. In this case, the expectancy will turn out to be 1 or 100%. So reward to risk also plays a very big role. We will also take note of what the trade expectancy formula will look like for a losing system. A common mistake that most traders make is taking small profits, hoping to win all the time, but then letting the losing trades get out of hand. Now consider a trader who wins 70% of the time, making 150 rupees on average when he wins, but he loses 400 rupees on his losing trades. So the expectancy in this case will come out to be negative 15 rupees. What this means is that for every trade this trader places, he can expect on average that 15 rupees will drain from his account. Over 10 trades, he can expect to lose 150 rupees. Please note that I am taking smaller values for easy understanding, and these numbers can be in lakhs or even crores for some traders. Now with a negative expectancy, the more trades taken, the more money is lost, and the trader may win often, but he is not profitable overall. So how can this trader become more profitable? Probably the easiest fix is to reduce the size of the losses, potentially with a logical and tighter stop loss. If this trader can reduce the losses to say 200 rupees, then he will be profitable even though he wins 150 rupees only. Even though the reward to risk is less than 1, we are considering this because this trader is winning more number of times. So the expectancy of the revised system will come out to be positive 45 rupees. So by reducing the losses, this trader can now expect to make 45 rupees on average every time he makes a trade. Now, I recommend you convert expectancy in terms of rupee value because it is easier to analyze and understand. So what this tells you is that the most important metric in your trading is not your reward to risk or winning rate standalone, but instead it is your overall trade expectancy. So in order to make objectively rational trades, you need to make sure every trade you take makes sense in terms of this formula. And you may also need to occasionally review the ongoing performance of your system by making sure your expectancy stays positive as new trades are being added to your trading journal. Now moving forward, let us understand how to set a stop loss for your trades. I have already made a detailed video on the method of setting a logical stop loss. You can check that out for a detailed explanation. However, I will briefly discuss this topic from a risk management perspective. When you think about stop loss, we should think about placing them on some structure in the market that will act as a barrier that will prevent the price from hitting your stop loss. Now, some of these market structures or barriers can be support and resistance levels, trend lines, moving averages, etc. Once you identify a structure to place your stop loss, the next step is to focus on the correct position sizing so that you don't lose a huge chunk of your capital when you get stopped out. Now, there is no limit to the number of shares that you can buy, and the only thing that limits you is your capital in hand. Deciding on position size without some logic to back up is not the way to go about it. So a more logical way to determine the position sizing is by using a simple formula, which is given by position size is equal to amount you're risking divided by the stop loss points. Let us say you are ready to risk 1000 rupees per trade and your stop loss is, let us say, 20 points. Now when you plug in the numbers into the formula, 1000 divided by 20, which is equal to 50 quantity. Now this is the maximum quantity that you can trade for the prescribed risk. Once the position sizing is set, the next step is to set a proper target and define your reward. There are a few ways of doing this, but the general idea is that you want to set your target at a level where there is a good chance that the market might reverse, which means you expect an opposing pressure to come in. So if you are a buyer, you look for a level where you can expect the sellers to come in, and vice versa if you are a seller. Now with that concept in mind, there are three possible areas to set your profit targets. Quite obviously, number one are the support and resistance levels, number two are the Fibonacci extension levels, and finally the chart pattern price projection levels. Now let me explain each one of them. Support, as you may all know, is an area where potential buying pressure is expected to come in, and resistance is an area where potential selling pressure could come in. Now what does this really mean? If you are in a long position, then you can consider taking profits at the resistance, and if you are in a short position, then you can consider taking profits at the support levels. Now this technique is very useful if the market is in a range or in a weak trend. Another crucial thing to keep in mind is that we should not aim for the absolute highs or lows of the levels to set your target, because the market may not reach these levels and might reverse beforehand. So always try to be more conservative with your profit targets and exit a few points earlier. The second method are using Fibonacci extension levels. A Fibonacci extension lets you project the extension of the current price swing. This technique is very useful for both strong and weak trends. Now the most important Fibonacci extension levels includes 127.2, 138.2 and 161.8% levels. Now here's how to use these levels. The first and foremost step is to identify a trending market. Let us say we have identified an uptrending market. Then find the most recent and significant swing highs and swing lows, and also make a note on the retracement after these swings, preferably at a Fibonacci retracement level from which you have taken a trade. Now the Fibonacci extension is a 3-point tool. So once you have identified the significant levels, select the Fibonacci extension tool, then draw the Fibonacci extension starting from the swing low to the swing high and the final point to a relevant retracement. Now all the Fibonacci extension levels are visible, and you can set your profit target at 127.2, 138.2, 161.8 or even 200% extension levels depending on how conservative or aggressive you are. The last method are the chart price projection method. Now the price projection is a classical charting principle where the price tends to exhaust when a chart pattern completes. A chart pattern is said to be complete when the price moves at an equal distance from the chart pattern. So I have already talked about this in my 1-hour chart pattern training. You can check that video out if you wanna know more. Now once we have the stop loss, position size and target set, it is now time to analyze the reward to risk ratio of the trade, because by doing so we are setting our targets and stop losses with logic behind them and not just setting them for the sake of meeting the required reward to risk ratio. So the reward to risk is given by the distance between the profit target divided by the distance of the stop loss. But instead of calculating it manually every time, you can use TradingView, which gives you a calculator which can easily calculate the reward to risk for every trade. All you have to do is to select the reward to risk tool on the left toolbar, then identify your entry, stop loss and target profit and draw it accordingly, and it will tell you your potential reward to risk ratio on the trade. As I have mentioned in the beginning of the video, that in order to calculate the expectancy of your trading strategy or system, you need a minimum sample space of trades between 30 to 100. Let's say after 100 trades, you calculate the expectancy and find out that you are still losing money or your system is negative expectancy system. So you don't have to be disappointed or disheartened, because I will give out some few tips to whomever is struggling to maintain a proper reward to risk or adequate win rate in their trades. So if your trading strategy is losing money, there are a few things that you can do to rectify it. Number one is obviously to trade with the trend and improve your winning rate, because it is a no-brainer and your odds of winning will be higher if you follow this thumb rule. So here's a basic guideline that you can use. If the price is above the 200 period moving average, only look for long trading setup, and if the price is below the 200 moving average, then only look for short setup. Do keep in mind that if you are more experienced and you have a good trading strategy, then it is always better to try to improve the system yourself. The second point to keep in mind is to set up proper stop loss. We have already discussed the stop loss part, but just to revise, if your stop loss is too tight, then your trade does not have enough breathing space to accommodate the market swings and volatility, and you will probably get stopped out by all the noise in the market, even though your analysis is correct. So how should you place your stop loss then? Just remember this thumb rule. Always set your stop loss at a level, if breached, will invalidate your trading setup. For example, if you are trading chart patterns, then your stop loss should be at a level where your chart patterns get invalidated. Or if you are trading a symbol support or resistance level, then your stop loss should be at a level where if the price reaches, then your support or resistance is broken. The third technique will help you to focus on the reward to risk. You need to find such trades with minimum or no barriers or obstacles. So if you think the price will move from level A to level B, then there should not be a level C in between that will act as an obstacle or barrier to the price movement. Or in simple terms, there should not be an opposing pressure or opposing player who can either block or reverse the movement of prices against your trade. For example, during an uptrend, you plan to buy at a swing low from a trend line and sell when the reversal from the next swing high happens. Let's say this trade has a 3:1 reward to risk ratio, but when you notice closely, there is an intermediate resistance level in between, which in this case can act as a barrier or obstacle to the up move. And since you can expect some selling pressure, your reward to risk reduces to 1:1. So I hope you understand the effect of having barriers on your reward to risk. So focus on finding those trades without many barriers in between. You may not get many opportunities, but when you get one, you can cash in a lot of points. And the last and final fix is to trade the most obvious levels. Now ask yourself what the most obvious levels in the market are. Without thinking much, the most common and the most significant answer one can find are the support and resistance levels, because these are the levels that attract the greatest number of order flows, which can result in a favorable reward to risk ratio on your trades. It is as easy as that to trade the support and resistance levels. Support and resistance levels can be a broad topic. It can be supply and demand zones, pivot levels, CPR, Camarilla, Fibonacci retracement levels, and a lot more. So experiment with these levels and find one or two that will suit your trading style and character. Now that is it for this particular video. Always keep your risk the first priority, because if you don't keep your risk under control, then it is more certain that you will be running a losing business over the long run. Always try to approach risk from a logical standpoint and not from an emotional standpoint, and I can guarantee you that it will work wonders in the future. So keep learning, keep practicing, keep improving, and keep trading. If you think this video was helpful, please do dropping a like, and if you are new to the channel, please do subscribe and enable the bell icon so that you won't miss out on the upcoming videos. I will see you guys in the next video. Till then, see you.